Welcome to FXTech's comprehensive NZD/USD analysis for October 13th through 18th, 2025. This week has been particularly significant for the New Zealand dollar, with major developments from the Reserve Bank of New Zealand and ongoing global economic pressures. In this analysis, we'll examine current market conditions, technical indicators, key news events, and provide actionable trading recommendations for both short-term and medium-term horizons. Let's dive into the details and uncover the opportunities in this dynamic currency pair. The NZD/USD pair is currently trading at 0.5743, marking a significant weekly decline of 2.15%. This downward movement reflects mounting pressure on the New Zealand dollar from multiple fronts. The pair has tested critical support levels around 0.5700, with traders closely monitoring whether this floor will hold. The broader trend remains bearish, influenced by diverging monetary policies between the RBNZ and the Federal Reserve. Volume has increased during the decline, suggesting strong conviction among sellers. This price action sets the stage for potential further downside movement. From a technical perspective, NZD/USD is displaying clear bearish momentum. The relative strength index sits at 38.5, approaching oversold territory, but not yet signaling a reversal. Both the 50-day and 200-day moving averages are trending downward, with the pair trading well below these key levels. The MACD indicator shows a bearish crossover, confirming the negative momentum. Support is established at 0.5700, 0.5650, and 0.5600, while resistance levels stand at 0.5800, 0.5850, and 0.5800.5900. These technical factors collectively point to continued downward pressure in the near term. Several critical news events have shaped NZD/USD dynamics this week. The Reserve Bank of New Zealand delivered a surprising 50 basis point rate cut, bringing the official cash rate to 4.25%. This aggressive move signals deep concerns about economic growth and inflation dynamics. Meanwhile, U.S.-China trade tensions have escalated, with former President Trump threatening 100% tariffs on Chinese goods. This development impacts New Zealand significantly, given China's role as its largest trading partner. Additionally, weaker than expected Chinese economic data has raised concerns about demand for New Zealand's key exports, particularly dairy products and commodities. The Reserve Bank of New Zealand's 50 basis point rate cut represents a major policy shift with far-reaching implications for the Kiwi dollar. Governor Adrian Orr emphasized the need for accommodative monetary policy to support economic growth amid global uncertainties. This dovish stance contrasts sharply with the Federal Reserve's more restrictive approach, widening the interest rate differential between the two currencies. The RBNZ has also signaled potential for further cuts if economic conditions deteriorate. This policy divergence creates a persistent headwind for NZD/USD as investors favor higher-yielding US dollar assets over New Zealand dollar holdings. Understanding key support and resistance levels is crucial for effective trading. The current price of 0.5743 sites precariously above immediate support at 0.5700. A break below this level could trigger accelerated selling toward major support at 0.5650, with the psychological level of 0.5600 serving as the next critical floor. These support zones represent areas where buying interest may emerge to stabilize the pair. Traders should monitor price action at these levels closely, as they often determine the next directional move and provide optimal entry points for position establishment. On the upside, NZD/USD faces substantial resistance that could cap any recovery attempts. Immediate resistance sits at 0.5800, representing the first hurdle for bulls to overcome. Above that, substantial resistance at 0.5850 marks a zone where sellers are likely to defend aggressively. The major resistance zone extends to 0.5900, which would require significant fundamental shifts to reach. The price visualization chart clearly illustrates the current position relative to these key levels, with red bars showing support below current price, gold representing the current level, and green bars indicating resistance above. This visual framework helps traders identify optimal entry and exit points. For the next 1 to 5 days, the short-term outlook for NZD/USD remains decidedly bearish. Technical indicators point to continued downside momentum with the immediate target at 0.5700 support. A break below this level would likely trigger a move toward 0.5650. Traders should watch for any bounce attempts near current levels, which could provide selling opportunities. Key catalysts to monitor include U.S. economic data releases, particularly inflation and employment figures, as well as any additional commentary from RBNZ officials. Risk sentiment will also play a crucial role, with risk-off flows typically benefiting the U.S. dollar at the expense of the Kiwi. Looking ahead 1 to 4 weeks, 3 fundamental drivers will shape NZD/USD direction. First, RBNZ policy divergence remains the primary headwind, with the central bank's continued dovish stance and potential for additional rate cuts, creating persistent pressure on the Kiwi. Second, China economic concerns weigh heavily, as weakening Chinese demand directly impacts New Zealand's export-dependent economy, particularly in dairy and commodities. Third, broad-based USD strength continues, supported by the Federal Reserve's restrictive monetary policy and safe haven flows amid global uncertainties. These factors collectively suggest a challenging environment for NZD bulls. Our scenario analysis presents 3 potential outcomes for the medium term. The bullish scenario, with 20% probability, targets 0.5850 to 0.5900, requiring positive China data, a Fed dovish pivot, and strong risk-on sentiment. The base case scenario, our highest probability at 55%, anticipates continued policy divergence, driving a gradual downtrend toward 0.5650 to 0.5700 with range-bound trading. The bearish scenario, at 25% probability, projects 0.5500 to 0.5600, triggered by additional RBNZ cuts, deepening China slowdown, and a USD surge. The base case represents our most likely path forward. For short-term traders, we recommend a sell-on-rally strategy, entering between 0.5770 and 0.5800, with stops above 0.5820, targeting 0.5700 and 0.5650 for a favorable risk-reward ratio of 1 to 2 to 1 to 3. Alternatively, consider a breakout short below 0.5700 with confirmation from a daily close, targeting 0.5650. Medium-term traders should employ a trend-following short strategy, entering between 0.5750 and 0.5800 with stops above 0.5850, targeting 0.5650 and 0.5600. A scale-in approach is also viable, building positions at 0.5800 and 0.5850 with a final stop above 0.5900. Position sizing should remain conservative at 1 to 2% of capital. Effective risk management is paramount in Forex trading. Never risk more than 1 to 2% of your capital on a single trade, and always use stop-loss orders to protect your positions. Monitor key support and resistance levels closely, and be prepared to adjust your strategy as market conditions evolve. Stay informed about RBNZ policy developments, U.S. economic data, and China economic indicators. Remember, this analysis is for educational purposes only and does not constitute financial advice. Always conduct your own research and consider consulting with a qualified financial advisor before making trading decisions. Trade responsibly and manage your risk carefully.